In today's financial landscape, understanding your credit score is no longer optional. It's essential. Think of your credit score as your financial report card. It tells lenders how trustworthy you are with money. A good credit score is your ticket to unlocking better financial opportunities. Without good credit, you might find yourself stuck. Imagine not qualifying for that dream home loan or facing sky-high interest rates on a car loan. Even worse, poor credit can limit your job prospects and increase insurance premiums. Building and maintaining good credit is crucial for anyone who wants to achieve financial stability and freedom. This guide will give you the tools and knowledge you need to master your credit score and take control of your financial future. Let's get started. A good credit score is like having a golden ticket in the financial world. It opens doors to lower interest rates on loans, better credit card offers, and even increased chances of getting approved for an apartment. With a strong credit score, you'll save thousands of dollars in interest payments over your lifetime. Imagine the possibilities: that dream vacation, a down payment on a home, or investing in your future. But it's not just about saving money. A good credit score gives you peace of mind. You'll have the financial security to handle unexpected expenses or pursue opportunities without being held back by poor credit. In simple terms, credit is the ability to borrow money or access goods and services with the promise to pay later. When you use credit, you're essentially taking out a loan. This loan can be in the form of a credit card purchase, a mortgage, an auto loan, or even a student loan. Your credit score is a numerical representation of your credit worthiness. It's based on your credit history, which includes how much debt you have, how often you make payments on time, and other factors. Understanding how credit works is the first step to building a strong credit history and achieving your financial goals. Revolving credit is the most common type of credit, and it's often associated with credit cards. With revolving credit, you're given a credit limit, which is the maximum amount you can borrow. You're free to use as much or as little of your credit limit as you'd like, as long as you make minimum monthly payments. The revolving part comes in when you make a payment. Instead of paying off the entire balance each month, as you would with an installment loan, the amount you pay back becomes available to use again. This cycle of borrowing and repaying can continue indefinitely, making it both convenient and potentially dangerous. While revolving credit can be a valuable tool for building credit and managing short-term expenses, it's important to use it responsibly. High credit card balances can lead to increased interest charges and damage your credit score. Section 2. Installment credit, building a solid foundation. Installment credit involves borrowing a fixed amount of money and repaying it over a set period, usually with fixed monthly payments. Common examples include mortgages, auto loans, and student loans. Each payment goes towards both the principal, which is the original loan amount, and the interest, which is the cost of borrowing. Installment credit is generally considered less risky than revolving credit because the terms are clearly defined up front. Lenders use your credit score to determine your interest rate and loan terms. A higher credit score often translates to lower interest rates, saving you money over the life of the loan. Having a mix of installment credit, such as a mortgage or auto loan, can demonstrate financial responsibility to lenders and contribute positively to your credit score. Section 3. Open credit, the often overlooked factor. Open credit, also known as charge accounts, allows you to receive goods or services and pay the balance in full each billing cycle. Unlike revolving credit, you're not given a preset spending limit. Instead, your spending limit fluctuates based on your credit worthiness and payment history. Common examples of open credit include utility bills like electricity, gas and water, cell phone service plans, and medical bills. While these accounts may not always appear on your credit report, late or missed payments can be reported to credit bureaus, negatively impacting your credit score. Managing open credit accounts responsibly is essential for maintaining a positive credit history. ensure timely payments, and keep track of due dates to avoid late fees and potential credit score damage. Section 4. The interplay of credit types. Understanding the different types of credit is crucial, but it's equally important to grasp how they interact to shape your overall credit profile. A healthy mix of credit types, including revolving, installment, and open credit, can signal to lenders that you're a responsible borrower who can manage different forms of debt. For example, having a credit card and making on-time payments demonstrates your ability to handle revolving credit, while a paid-off car loan showcases your successful management of installment credit. However, having too much of one type of credit can be detrimental. For instance, multiple credit card accounts with high balances can raise red flags for lenders even if you make payments on time. Section 5. Choosing the right credit for your needs. Navigating the world of credit requires careful consideration of your individual financial situation and goals. Each type of credit serves a different purpose, and selecting the right one for your needs is crucial. If you're looking to build credit or need a flexible way to manage everyday expenses, a credit card with a low interest rate and rewards program might be a good fit. For larger purchases like a home or car, an installment loan with a fixed interest rate and manageable monthly payments is generally the better option. Before applying for any type of credit, it's essential to research different lenders, compare terms and conditions, and choose an option that aligns with your budget and long-term financial goals. Section 1. The importance of knowing your credit report. Imagine applying for a loan only to be denied because of inaccurate information on your credit report. Or worse, discovering that someone has stolen your identity and opened fraudulent accounts in your name. These scenarios, while unsettling, highlight the critical importance of knowing and understanding your credit report. Your credit report is a detailed record of your credit history, compiled by credit bureaus and used by lenders to assess your credit worthiness. It's essentially your financial track record, influencing your ability to secure loans, rent an apartment, and even land certain jobs. Regularly reviewing your credit report empowers you to identify errors, detect potential fraud, and proactively manage your financial health. Knowledge is power, and when it comes to your credit, this knowledge can save you time, money, and unnecessary stress. Section 2. Accessing your credit reports, a step-by-step guide. Obtaining your credit reports is easier than you might think. You're entitled to a free credit report from each of the 3 major credit bureaus, Equifax, Experian, and TransUnion, once every 12 months. These reports can be accessed online, by phone, or by mail. The most convenient and efficient way to request your reports is through the official website, authorized by federal law annualcreditreport.com. Once on the website, follow the simple instructions to provide your personal information and verify your identity. You'll have the option to view your credit reports online immediately or have them mailed to you. It's recommended to request all 3 reports simultaneously, as they may contain different information, providing a comprehensive view of your credit history. Section 3. Understanding the contents of your credit report. Your credit report, while seemingly complex at first glance, can be broken down into manageable sections, each providing valuable insights into your credit history. Typically, a credit report includes the following key sections. This section contains your name, address, social security number, date of birth, and previous addresses. Ensure this information is accurate, as any discrepancies can lead to errors and delays. This section lists all your credit accounts, including credit cards, mortgages, auto loans, and student loans. Details such as account balances, credit limits, payment history, and account status are provided. This section lists entities that have accessed your credit report, such as lenders, employers, and landlords. It's essential to review this section for any unauthorized inquiries which could indicate potential fraud. This section includes information from public records that can affect your credit, such as bankruptcies, tax liens, and judgments. Section 4. Identifying and addressing errors, protecting your financial identity. While credit bureaus strive for accuracy, errors can occur, potentially harming your credit score and financial well-being. When reviewing your credit report, carefully scrutinize each section for any inaccuracies, inconsistencies, or unfamiliar entries. Common errors include misspellings, outdated addresses, or incorrect social security numbers can lead to errors and misinterpretations. Incorrect account balances, credit limits, or payment history can negatively impact your credit worthiness. Multiple entries for the same account can create confusion and inflate your debt-to-credit ratio. Unfamiliar inquiries could indicate that someone has accessed your credit report without your permission, potentially signaling identity theft. Section 5. The role of credit bureaus. Gatekeepers of your financial information. Credit bureaus play a pivotal role in the financial ecosystem, acting as repositories of consumer credit information. They collect data from various sources, including lenders, creditors, and public records, compiling it into comprehensive credit reports. These reports are then used by lenders, landlords, employers, and other entities to assess your credit worthiness and make informed decisions. The three major credit bureaus, Equifax, Experian, and TransUnion, operate independently, each maintaining its own database and scoring models. While credit bureaus provide a valuable service, it's essential to remember that they are for-profit companies and their primary responsibility is to their shareholders, not necessarily consumers. Section 6. Credit scores versus credit reports. Understanding the difference. While often used interchangeably, credit scores and credit reports are distinct concepts. Your credit report is a detailed history of your credit activity, containing information about your credit accounts, payment history, and public records. It's a factual document, outlining your financial track record. Your credit score, on the other hand, is a numerical representation of your credit worthiness, derived from the information in your credit report. It's a snapshot of your credit risk at a specific point in time, used by lenders to assess your likelihood of repaying a loan. Understanding the distinction between these two concepts is crucial for effectively managing your credit. Your credit report provides the foundation for your credit score, and any inaccuracies or negative entries on your report can directly impact your score. Section 7. Establishing a credit review routine. Stay informed, stay in control. Just like scheduling regular checkups with your doctor or dentist, establishing a routine for reviewing your credit report is essential for maintaining optimal financial health. Aim to review your credit report from each of the three major bureaus at least once a year, taking advantage of the free annual reports provided by annualcreditreport.com. Spread out your requests throughout the year, reviewing one report every 4 months. This staggered approach allows you to monitor your credit more frequently, increasing the likelihood of catching errors or discrepancies early. Consider setting calendar reminders or utilizing credit monitoring services that provide alerts for any changes or suspicious activity on your credit report. Section 8. Safeguarding your credit information tips for protecting your data. In today's digital age, protecting your sensitive personal and financial information is paramount. Identity theft and credit fraud are growing concerns, making it crucial to adopt proactive measures to safeguard your credit. Start by creating strong, unique passwords for all your online accounts, and avoid using the same password for multiple platforms. Be wary of phishing scams, where fraudsters attempt to trick you into revealing personal information through deceptive emails or websites. Shred sensitive documents before discarding them, and monitor your bank and credit card statements regularly for any unauthorized transactions. By taking these precautions, you can significantly reduce your risk of becoming a victim of credit fraud. The impact of negative items. Understanding the stakes. Negative items on your credit report cast a long shadow, potentially impacting your financial well-being for years to come. These blemishes, ranging from late payments to bankruptcies, signal to lenders that you may pose a higher risk of defaulting on future obligations. The consequences can be far-reaching, affecting your ability to secure loans, rent an apartment, or even land certain jobs. Imagine being denied a mortgage because of a missed payment from several years ago, or facing exorbitant interest rates on a car loan due to a collection account. Understanding the stakes involved underscores the importance of proactively addressing negative items on your credit report. While some entries may accurately reflect your payment history, errors and inaccuracies can occur, requiring swift action to protect your creditworthiness. Common credit report errors. Identifying the culprits. Credit reports, while generally accurate, are not immune to errors. Mistakes can occur during data entry, information sharing between creditors and credit bureaus, or even due to identity theft. Identifying these errors is crucial, as even seemingly minor inaccuracies can have a significant impact on your credit score. Common credit report errors include incorrect personal information. Misspellings, outdated addresses, or inaccurate social security numbers can create confusion and lead to misinterpretations. Inaccurate account details, incorrect account balances, credit limits, or payment history can negatively impact your creditworthiness. Duplicate accounts. Multiple entries for the same account can artificially inflate your debt-to-credit ratio, making you appear riskier to lenders. Unauthorized inquiries. Unfamiliar inquiries could indicate that someone has accessed your credit report without your permission, potentially signaling identity theft. Gathering evidence. Building a strong case for dispute. Disputing errors on your credit report requires more than simply notifying the credit bureau. You need to build a compelling case backed by solid evidence to support your claim. Gathering the right documentation is crucial for a successful dispute. Start by printing a copy of your credit report, highlighting the specific errors you wish to dispute. Then, gather supporting documents that contradict the inaccurate information. For instance, if you're disputing a late payment, provide copies of bank statements or canceled checks showing on-time payments. If you're disputing an account that you don't recognize, gather any evidence that supports your claim, such as identity theft reports or affidavits from creditors confirming that you didn't open the account. Section 4. Dispute Letter Essentials. Crafting a compelling argument. A well-crafted dispute letter is the cornerstone of a successful credit report dispute. This letter serves as your formal communication with the credit bureau, clearly outlining the errors you're disputing, the supporting evidence you're providing, and the desired outcome. When writing your dispute letter, be concise, factual, and professional. Avoid emotional language or personal opinions. Start by clearly identifying yourself and the credit report you're disputing, including the report number and date. Then, clearly state the specific items you're disputing, providing a brief explanation for each error and referencing the supporting documents you've enclosed. Conclude by requesting that the credit bureau investigate the disputed items and correct or remove them from your credit report. Section 1. Decoding your credit score. A look under the hood. Imagine your credit score as a complex recipe, with each ingredient playing a crucial role in determining the final outcome. Just like a master chef carefully balances flavors, credit scoring models use sophisticated algorithms to analyze various aspects of your credit history, assigning different weights to each factor. Understanding these factors and their relative importance empowers you to make informed financial decisions, ultimately influencing your creditworthiness in the eyes of lenders. By demystifying the components of your credit score, we can unlock the secrets to building and maintaining a healthy credit profile, paving the way for greater financial freedom and stability. Section 2. Payment history, 35%. The cornerstone of creditworthiness. Imagine applying for a loan, and the lender's first question is, how reliably have you repaid your debts in the past? This, in essence, is the crux of payment history, the most heavily weighted factor in your credit score, accounting for a significant 35%. Lenders view your past payment behavior as a strong predictor of future performance. A history of on-time payments signals financial responsibility, indicating that you're likely to honor your financial obligations in the future. Conversely, late payments, missed payments, collections, charge-offs, and bankruptcies paint a less favorable picture, potentially raising red flags for lenders and lowering your credit score. Section 3, amounts owed, which makes up 30% of your credit score, is all about striking a balance between utilization and debt. While payment history focuses on the timeliness of your payments, amounts owed delves into how much debt you're carrying relative to your available credit. This factor, also known as credit utilization, accounts for 30% of your credit score and plays a crucial role in assessing your credit risk. Imagine having a credit card with a $10,000 limit and a balance of $9,000. While you might be making payments on time, your high credit utilization at 90% suggests that you're heavily reliant on credit and potentially at risk of overextending yourself. Lenders generally favor lower credit utilization ratios, ideally below 30%. This indicates that you're using credit responsibly and have a healthy buffer to handle unexpected expenses or financial emergencies. Section 4, length of credit history, which accounts for 15% of your credit score, considers time as a factor in creditworthiness. Just as a seasoned chef hones their skills over years of experience, your credit history gains credibility with time. Length of credit history, accounting for 15% of your credit score, considers the age of your credit accounts, providing lenders with a broader perspective on your financial track record. A longer credit history, characterized by well-managed accounts over an extended period, demonstrates financial stability and maturity, assuring lenders that you've successfully navigated various financial situations. While establishing credit takes time, it's never too early to start building a positive credit history. The sooner you begin managing credit responsibly, the sooner you'll reap the benefits of a strong credit score. Section 5. New credit, which makes up 10% of your credit score, is all about navigating the impact of new accounts. Imagine opening several new credit card accounts in a short period. While this might seem like a quick way to boost your available credit, it can actually have the opposite effect, potentially lowering your credit score due to the impact of new credit. This factor, accounting for 10% of your credit score, reflects your recent credit activity, including new credit applications and newly opened accounts. Lenders view a flurry of new credit inquiries as a potential red flag, suggesting that you might be experiencing financial difficulties or overextending yourself. Each new credit application triggers a hard inquiry on your credit report, which can temporarily lower your score by a few points. While the impact of a single hard inquiry is usually minor, multiple inquiries within a short period can raise concerns for lenders. Section 6. Credit mix, accounting for 10% of your credit score, is all about demonstrating financial versatility. Imagine a chef who can effortlessly prepare a multi-course meal, showcasing their culinary versatility. Similarly, your credit mix reflects the diversity of your credit accounts, demonstrating your ability to manage different types of debt responsibly. A healthy credit mix typically includes a combination of revolving credit, like credit cards, installment credit, such as mortgages and auto loans, and open credit, like utility bills. This diversity signals to lenders that you're comfortable handling various forms of credit and have experience managing different repayment structures. While having a diverse credit mix can be beneficial, it's essential to avoid opening unnecessary accounts solely to improve this factor. Focus on responsibly managing the accounts you have and only apply for new credit when you genuinely need it. Understanding credit score ranges from subprime to exceptional. Credit scores use a numerical scale to gauge your creditworthiness. The FICO score ranges from 300 to 850. Lenders use these scores to assess your credit risk. Higher scores translate to better loan terms and lower interest rates. Here's a breakdown of credit score ranges and their implications. Exceptional from 800 to 850. Borrowers in this range qualify for the best loan terms and interest rates. Very good from 740 to 799. This range represents a strong credit history and favorable loan options. Good from 670 to 739. Borrowers in this range may qualify for loans with higher interest rates. Fair from 580 to 669. Poor from 300 to 579. Borrowers in this range face challenges with limited options and high interest rates. Section 8. Factors that don't affect your credit score, dispelling common myths. Navigating the world of credit can feel like traversing a minefield of misinformation. Myths and misconceptions abound, often leading to unnecessary anxiety and potentially harmful financial decisions. Let's debunk some common credit score myths and shed light on the factors that don't affect your score. Myth 1. Checking your credit score lowers it. Checking your own credit score is a soft inquiry and doesn't impact your score. Myth 2. Closing old credit card accounts improves your credit score. Closing old accounts can hurt your credit score. Myth 3. Your income affects your credit score. Your income isn't a direct factor in your credit score. Myth 4. Your age influences your credit score. Age isn't a factor in credit scoring. Section 9. The importance of monitoring your credit. Stay informed, stay protected. Imagine receiving a call from a lender, informing you that your loan application was denied due to suspicious activity on your credit report. This scenario, while unsettling, highlights the critical importance of regularly monitoring your credit. Credit monitoring serves as your first line of defense against identity theft, errors, and inaccuracies that can negatively impact your creditworthiness. By proactively tracking your credit, you can detect and dispute errors, identify inaccuracies in your credit report, such as incorrect personal information, inaccurate account details, or fraudulent accounts, and take prompt action to dispute them. Prevent identity theft. Recognize suspicious activity, such as unfamiliar inquiries or new accounts you didn't open, and take immediate steps to mitigate potential damage. Track your progress. Monitor your credit score over time, observing the impact of your financial decisions and identifying areas for improvement. Section 10. Taking control of your credit. Empowering your financial future. Mastering your credit score isn't about memorizing complex algorithms or obsessing over every point fluctuation. It's about empowering yourself with the knowledge and tools to make informed financial decisions that align with your long-term goals. By understanding the factors that influence your credit worthiness, you can take proactive steps to build a positive credit history, paving the way for greater financial freedom and stability. Remember, your credit score is a reflection of your financial habits, and like any habit, it can be improved with consistent effort and a commitment to responsible credit management. Embrace the journey, celebrate your successes, and never underestimate the transformative power of a healthy credit profile. Section 1. Assessing the damage. Taking stock of your credit situation. Imagine a doctor diagnosing a patient before prescribing a treatment plan. Similarly, embarking on a credit repair journey begins with a thorough assessment of your current credit standing. Start by obtaining your credit reports from all three major credit bureaus, Equifax, Experian, and TransUnion. Carefully review each report, noting any negative items such as late payments, collections, or charge-offs. Pay close attention to the dates of these entries, as the age of negative information plays a role in its impact on your credit score. Older entries generally carry less weight than more recent ones. Identify the factors that are most likely contributing to your low credit score. Is it a history of late payments, high credit card balances, or a lack of credit history? Pinpointing these areas allows you to focus your efforts strategically. Section 2. Creating a credit repair plan, a roadmap to recovery. Once you have a clear picture of your credit situation, it's time to develop a personalized credit repair plan. This plan serves as your roadmap to recovery, outlining the steps you'll take to address negative items, build positive credit habits, and ultimately improve your credit score. Start by prioritizing the negative items you want to tackle first. Focus on the most impactful entries, such as recent late payments or accounts in collections. Next, establish realistic goals and timelines. Credit repair is a marathon, not a sprint, and expecting overnight results can lead to disappointment. Break down your goals into manageable steps, such as making all payments on time for the next 6 months or reducing your credit card balances by a certain percentage. Section 3. Tackling credit card debt. Strategies for reducing balances. High credit card balances are often a major culprit behind low credit scores. Reducing your credit card debt not only improves your credit utilization ratio, a key factor in credit scoring, but also frees up more of your income each month. Start by creating a budget to track your income and expenses, identifying areas where you can cut back on spending and allocate more money toward debt repayment. Consider using the debt snowball or debt avalanche method to prioritize your debt repayment. The debt snowball method focuses on paying off the smallest balances first, creating a sense of momentum, while the debt avalanche method targets the highest interest rate debts first, saving you money on interest charges over the long term. Section 4. Negotiating with creditors. Seeking payment arrangements and debt settlement. If you're struggling to make payments on your debts, don't hesitate to reach out to your creditors and explore potential options for relief. Many creditors are willing to work with borrowers who are facing financial hardship, offering payment arrangements, reduced interest rates, or even debt settlement programs. When contacting your creditors, be prepared to explain your situation clearly and provide documentation to support your claims. Be polite and persistent, but avoid making promises you can't keep. Keep detailed records of your conversations, including the date, time, and the representative you spoke with. Section 5. Building positive credit habits. Laying the foundation for long-term success. Repairing your credit isn't just about addressing past mistakes, it's about establishing sustainable financial habits that will serve you well in the long run. Building positive credit habits is essential for maintaining a healthy credit score and achieving your financial goals. One of the most impactful habits you can develop is making all your payments on time, whether it's for credit cards, loans, utilities, or rent. Consider setting up automatic payments or calendar reminders to avoid missed due dates. Late payments can stay on your credit report for up to 7 years, negatively impacting your credit score during that time. Section 6. Leveraging secured credit cards. Rebuilding credit with a safety net. Secured credit cards can be a valuable tool for rebuilding credit, especially if you're having trouble getting approved for traditional unsecured cards. Unlike unsecured cards, which don't require a security deposit, secured cards require you to put down a cash deposit that serves as collateral. This deposit typically equals your credit limit, minimizing the risk for the lender. By using a secured card responsibly, making on-time payments and keeping your balance low, you can demonstrate to lenders that you're a trustworthy borrower, potentially paving the way for future approval for unsecured credit. Section 7. Patience is key. Understanding the time frame for credit repair. Credit repair is not a quick fix, and expecting immediate results can lead to frustration and disappointment. The time it takes to repair your credit depends on various factors, including the severity of the negative items on your report, your credit history, and the consistency of your efforts. While some improvements may be noticeable within a few months, it can take several years to fully repair damaged credit. Negative items such as late payments or collections can remain on your credit report for up to 7 years, although their impact diminishes over time. Bankruptcies can stay on your report for up to 10 years, but with consistent effort and positive credit habits, you can rebuild your credit and regain financial stability. Seeking professional help. Navigating credit repair services. If you're feeling overwhelmed by the credit repair process or unsure where to begin, seeking professional guidance from a reputable credit counseling agency can be beneficial. Credit counselors can provide personalized advice, help you develop a budget, and negotiate with creditors on your behalf. However, it's essential to approach credit repair services with caution. Beware of companies that promise quick fixes or guaranteed results, as these claims are often too good to be true. Legitimate credit repair companies cannot remove accurate negative items from your credit report, but they can help you dispute errors and negotiate with creditors. The importance of ongoing vigilance. Imagine diligently repairing your credit, meticulously addressing errors, and establishing responsible financial habits, only to let your guard down and find yourself back at square one. Maintaining good credit requires ongoing vigilance, a commitment to safeguarding your financial well-being long after you've achieved a healthy credit score. Think of it like tending to a garden. Consistent care, nurturing, and attention are essential for sustained growth and vibrancy. Complacency can be detrimental, allowing small oversights to snowball into significant setbacks. By remaining vigilant, you empower yourself to address potential issues promptly, protecting your creditworthiness and ensuring your financial goals remain within reach. Establishing healthy credit habits for the long haul. Maintaining good credit isn't about following a strict set of rules, it's about integrating responsible financial practices into your daily life. These habits, once established, become second nature, effortlessly guiding you toward financial well-being without requiring constant willpower or sacrifice. Start by making on-time payments a non-negotiable priority. Late payments, even by a single day, can negatively impact your credit score, undoing months of diligent effort. Set up automatic payments or calendar reminders to ensure bills don't slip through the cracks. Consider consolidating your credit card debt onto a single card with a lower interest rate, simplifying your payments and potentially saving you money on interest charges. Section 3. Leveraging credit monitoring tools. Early detection and protection. Imagine having a security system for your credit, alerting you to suspicious activity and potential threats before they escalate. Credit monitoring tools provide this invaluable service, acting as your vigilant guardians in an increasingly complex financial landscape. These tools offer a range of features, including credit score tracking. Monitor your credit score from all three major bureaus, receiving alerts for significant changes that could indicate errors or potential fraud. Fraud alerts. Receive real-time notifications for suspicious activity, such as new credit inquiries, account openings, or address changes you didn't authorize. Credit report. Access. Conveniently access your credit reports from all three bureaus, allowing you to review for inaccuracies, identify potential areas for improvement, and track your progress over time. Identity theft protection. Some credit monitoring services offer additional layers of protection, such as identity theft insurance, lost wallet assistance, or dark web monitoring, to safeguard your personal information. Section 4. Navigating life events and their impact on credit. Life is full of unexpected twists and turns, and these events can sometimes impact our creditworthiness in unforeseen ways. Marriage, divorce, job loss, relocation, or even a serious illness can all have implications for our credit scores, requiring adjustments to our financial strategies. When facing major life changes, it's essential to communicate with creditors. Inform your creditors of any changes to your financial situation, such as a job loss or reduced income, and explore potential options for hardship assistance, such as payment deferrals or reduced interest rates. Review your credit report more frequently. During times of transition, it's crucial to monitor your credit report more closely for any errors or inaccuracies that may arise due to address changes, name changes, or other updates. Adjust your budget and financial goals. Life events often necessitate adjustments to our financial plans. Reassess your budget, prioritize essential expenses, and consider revising your savings or debt repayment goals to align with your current circumstances. Section 5. Embracing a proactive approach to credit management. Mastering your credit isn't about achieving a perfect score and then resting on your laurels. It's about embracing a proactive mindset, viewing your credit as an ongoing journey rather than a destination. By adopting a proactive approach, you empower yourself to navigate the complexities of the financial world with confidence, knowing that you have the knowledge and tools to overcome challenges and achieve your financial aspirations. Remember, your credit score is a reflection of your financial habits, and like any habit, it can be continuously improved with consistent effort and a commitment to responsible credit management. Embrace the journey, celebrate your successes, and never underestimate the transformative power of a healthy credit profile. Congratulations! By completing this comprehensive guide to understanding, repairing, and maintaining a healthy credit score, you've embarked on an empowering journey toward financial well-being. You've delved into the intricacies of credit reports, demystified the factors that influence your creditworthiness, and equipped yourself with the tools to address challenges and achieve your financial goals. Remember that feeling of accomplishment as you move forward, applying what you've learned to make informed financial decisions. This journey is not about achieving a perfect credit score or obsessing over every point fluctuation. It's about shifting your mindset from feeling overwhelmed and uncertain to feeling empowered and in control of your financial destiny. Every step you take toward responsible credit management brings you closer to a brighter financial future. As you navigate the complexities of the financial world, keep in mind that your credit score is a reflection of your financial habits. By consistently applying the principles outlined in this guide, you'll not only improve your creditworthiness but also cultivate a sense of financial confidence that extends to all aspects of your life. Now that you have the knowledge, it's time to turn that knowledge into action. Don't let this information sit idly by. Put it to work for you and watch your financial well-being flourish. Start by setting realistic goals, whether it's securing a favorable loan, qualifying for a better credit card, or simply achieving peace of mind. Having clear objectives will keep you motivated and focused on your journey to credit mastery. Remember, even small steps can lead to significant progress over time. Start by reviewing your credit reports regularly, disputing any errors, and establishing a budget to track your income and expenses. Every positive action you take, no matter how small, contributes to a stronger credit history and a brighter financial future. Your credit score is a journey, not a destination. There will be challenges along the way, but don't be discouraged. Embrace the learning process, celebrate your successes, and never underestimate the transformative power of consistent effort and responsible credit management. Section 3, From Understanding to Action. Putting knowledge into practice. Understanding the intricacies of credit is commendable, but the true power lies in putting that knowledge into practice. Transform information into action by implementing the strategies outlined in this guide. Begin by requesting your free credit reports from annualcreditreport.com. Carefully review each report, noting any discrepancies or inaccuracies. Dispute any errors you find with the credit bureaus, providing supporting documentation to strengthen your case. Remember, you have the right to accurate reporting, and taking the time to correct mistakes can significantly impact your creditworthiness. Section 4. Building a legacy of financial well-being. Mastering your credit isn't just about securing a favorable loan or qualifying for a better credit card. It's about building a legacy of financial well-being for yourself and your loved ones. By adopting responsible credit habits, you're not only improving your own financial future, but also setting a positive example for your children, family, and friends. Imagine the impact of passing down your knowledge and empowering those around you to make informed financial decisions. Share the insights you've gained from this guide, encourage open conversations about money, and help others avoid the pitfalls of poor credit management. By fostering a culture of financial responsibility, you're creating a ripple effect that extends far beyond your immediate circle, contributing to a more financially secure and empowered society. Section 5. Remember, you are not alone. Navigating the world of credit can feel overwhelming at times, but it's crucial to remember that you are not alone. Countless resources, tools, and support systems are available to guide you on your journey to credit mastery. From reputable credit counseling agencies to online communities, seeking guidance when needed is a sign of strength, not weakness. Don't hesitate to reach out to financial advisors, credit counselors, or trusted friends and family members who have experience managing credit responsibly. Sharing your challenges and seeking different perspectives can provide valuable insights and support as you work towards your goals. Remember, building and maintaining good credit is an ongoing journey, and seeking support along the way can make all the difference. Section 6. Embrace the journey, celebrate the victories. As you embark on your journey to credit mastery, remember to embrace the process and celebrate your victories along the way. Every positive step you take, whether it's making a payment on time, reducing your credit card debt, or simply gaining a better understanding of your credit report, is a reason to acknowledge your progress. Building and maintaining good credit takes time, effort, and consistency. There will be challenges along the way, but don't let setbacks discourage you. View them as learning opportunities, adjust your strategies as needed, and keep your long-term goals in mind. As you witness your credit score improve and your financial goals become attainable, take the time to appreciate how far you've come. Remember, mastering your credit is an ongoing journey, and every step you take brings you closer to a brighter financial. The information in this video is for educational and entertainment purposes only, and is not intended as financial advice. We are not financial advisors, and the content should not be construed as professional financial advice. Always seek the advice of a qualified financial advisor or other professional regarding your specific financial situation. The use of any information provided in this video is solely at your own risk. Please remember to like and subscribe for more Money Smart Basics videos.